Let me now bring on board David Pizarkar, Head of Equities with Daiwa AMC. David, morning. Thank you for joining us. David, 25% run up this year, 9% in the month of September and October put together. What are we staring at for rest of the month and then for rest of the year?
Good morning, Nikunj. Thank you for having me. Yes, we have had a excellent year so far, quite against most people's expectations, and I think there is a possibility that the markets might consolidate a little bit, look at the quarterly results, because I think earnings might be a little bit tepid, but the underlying sentiment remains positive, and I think we will see a further steps towards incremental reforms, which will also keep the positive sentiment up. So I think investors should look at any kind of a corrective phase to add on to their equity holdings. And it also looks like the government wants to reignite the capex cycle. So I think one should look at the investment-oriented companies, capex-oriented companies from here on. Of course, they have had a stellar run in the past month. And I think this quarter results for these companies particularly will not be that encouraging. So any price reaction, adverse price reaction in those stocks should definitely be looked at to add to one's holdings, I think. So I think overall for this month, maybe the market remains flat, but we are positive on the markets going ahead. So I think we will see a decent price appreciation for the remainder of the year.
David, so what's the call on the earnings season? And we kickstart with Infi later this week. No guidance this time, but how do you think the performance is going to be?
Well, I think because of the rupee, there might be a downtick in the earnings expectations, etc. But I think what we have seen from the earlier results is that there is some incremental improvement in terms of the underlying business momentum. This quarter generally is good for the IT companies, but this year might not be that positive because businesses overall remain quite cautious. So I think people will be looking at what sort of commentary one hears in terms of the expectations for the second half. But I think overall, although the underlying business momentum for the IT companies will remain positive, because of the rupee appreciation, I think investors would want to remain cautious in this particular sector, wait for the rupee to stabilize at a particular level, and then take a call. We are positive on the IT sector, but then our stance is also to wait to see up to what extent the rupee appreciates, and then take a fresh view on this sector.
David, are you a bit surprised that the FMCG and defensives are holding on? I guess the consensus on the trade on the street is that it's time to sell defensives, time to revisit high beta names, or time to start buying investment-oriented stocks.
Yes, I think that was the consensus trade, and we had also trimmed a little bit in these defensive sectors. But then what we are seeing is that rural demand, although it has not completely fallen off, it might have softened a little bit. But then raw materials seem to be working in their favor, at least for this quarter. We will wait to see this quarter numbers and see how the rural demand is panning out. There doesn't seem to be a large adverse impact on that. That is what is, I think, reignited this sector. Valuations definitely remain high, but what has happened is that most of the institutional portfolios are not overweight on this particular sector. So at every price fall, people are at least trying to get to a neutral kind of a position, at least as far as these sectors are concerned, which is what is keeping the price in their favor. If you look at the other defensive sector, pharma, that has had an impact because of the recent government policies in terms of the price controls, etc. And that is also impacted because of the rupee appreciation. So if one has to look at from a portfolio standpoint, and if one wants to allocate some money to the defensive sectors, so the traditional defensive sectors such as, the pharma sector as of now looks to be a little bit riskier compared to the FMCG sector. And the IT sector also, again, is affected by the rupee appreciation. So that is why most of the money, I think, has remained in the FMCG sector, or is using any kind of opportunity of a price fall to get into this sector, because of no other alternative defensive sector available.
David, what is your sense on the entire capital goods space? Because a lot of experts are now getting a little wary about names like a Crompton, or for that matter, BHEL as well. Do you think order visibility is going to continue to be a challenge, as would be execution?
Yes, I think order visibility as well as execution will remain challenging, whereas some companies could see some sort of a margin expansion because of various cost-cutting initiatives, etc. But revenue momentum will remain weak, and there are underlying challenges for the sector. However, what has happened is that we have seen this optimism develop because of these reform process and the lack of credible alternatives in terms of a high beta play. If one looks at what one wants to play in terms of high beta kind of a sector, then metals do not fit in because of the global weakness. That is why capital goods have found favor, and it seems that that might continue because global weakness, particularly Chinese growth and European slack, etc., is likely to weigh on the underlying commodity prices, which is also a secondary positive for the capital goods companies. So overall, sentiment towards the capital goods companies will remain positive. This quarter will remain challenging, so there could be a price correction, but I think investors will be looking at this kind of a price correction to get into the well-managed stocks.
David, at a time when there is only hope that the economic cycle will revive, what is driving PSU banks? Because for PSU banks, NPA levels are high, credit growth rate has gone down. So what is driving these banks? Value, hope, or liquidity?
Well, there is a bit of value picking there. PSU banks, some of the smaller ones were trading at 0.5, 0.6 times book. But what you said earlier is absolutely right. NPA levels will remain high. Restructuring for this quarter as well is likely to remain a concern. So we would be a bit cautious as far as PSU banks are concerned. We would want to see this quarter numbers, outlook in terms of further restructuring, what is the outlook in terms of the SME loans, etc., and then take a call on the PSU bank sector. Compared to this, the private bank sector, although looking expensive in terms of pure valuations, I think would be a safer bet to play on the economic revival. I think it would be better to wait for another quarter or so to take a more fundamental call on the PSU banks.
David, so how exactly do you think the polarized nature of this market will change? Because if I map the market, let's say from Jan to August, markets have been extremely polarized. It's only in the month of September that the other sectors have chipped in.
Yes, I think that is true generally when one sees the start of a large bull cycle. Initially, you will have only a few sectors participating, and only then when the perceived benefits of the improved GDP growth, etc., are seen to permeate across all the sectors, only then the other sectors will participate. So that is likely to continue. I think sectors where there are no underlying balance sheet concerns will continue to outperform. At the same time, where there is a possibility that the investment revival will help immediately, although the balance sheet there might be a little bit stretched. So we will see a combination of this continue at least until the end of the year. I think only when we have a complete secular kind of a bull market, you will see all the sectors participating. Otherwise, it is likely to remain selective.
David, is the street as well pricing in a rate cut by the Reserve Bank of India later in the month?
Yes, I think this week's industrial production number data point will show a weak production number, which markets will assume is likely to influence the RBI towards a sort of a rate cut or some sort of further liquidity easing. While a rate cut looks quite difficult at this point, given that inflation might remain high because fuel prices also need to be incorporated. So it is possible that the RBI looks at some sort of liquidity easing measures or increased intervention in the foreign exchange market, which in turn will improve liquidity in the domestic rupee market. So I think there would be some easy liquidity steps by the RBI, but it is difficult to see the RBI actually going ahead with a rate cut, given that the headline inflation numbers might remain high.
Closing comments, 30 seconds. Do you have a Nifty number in mind for December and for March end?
Well, I don't have a specific number in mind, but given that even after this kind of a run-up, the market is trading at close to 14 times forward, if one takes extremely conservative kind of earnings numbers, and there is a possibility of an upgrade happening for the next year, I think under no circumstances does the market look stretched. So I would think that any kind of correction in the market should be looked at to accumulate stocks, and I think over a year or so one can easily see a 15 to 18% kind of a return from the markets.